Nearly half of the world's largest companies are staring down the barrel of obsolescence. The clock is ticking.
42% of CEOs don't think that their business model is reliable for the next 10 years if they don't change.
So they pour millions into corporate venture capital. But here's the brutal reality.
That's the valley of death for all CVCs.
3.7 years. That's how long the average corporate venture fund survives before getting shuttered. But what separates the winners from the write-offs?
In this perfect world, common understanding that corporate venture capital, and venture capital in general, by the way, is only working with a strong portfolio approach. If you don't have 20 or something startups in your bucket, then it can't work on a long term.
While European corporates hesitate, their American counterparts are already dominating the game.
I think they invest more in venture capital than any European corporate is doing right now.
The question that should terrify every boardroom.
Name me an example of a large company which was able to reinvent its business model out of itself without working with M&A or venture or startups.
Can't think of one? Neither can we. Join us as Florian Noell of PwC reveals the mindset shift that turns corporate venture capital from expensive experiment into strategic lifeline. This is the European VC Podcast.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Welcome back to another episode of the European VC Podcast, where we connect and champion the voices that shape European venture. And as you know, we're zooming in more and more on the CVC landscape. And to do that today, we have Florian Noell, PwC's Global Venturing and EMEA Startups and Scale-Ups Leader. That was difficult for me. He's obviously a figure uniquely positioned to talk about the intersection of global consulting, corporate innovation, and the startup ecosystem. So Jeppe, other than what I just said, why did you think that we should bring Florian on for today's conversation?
I've met Florian a couple of times in the German ecosystem and in the European ecosystem. Then myself started my career at PwC, where Florian is now working. So for that reason, it's super interesting to have him join us. Then Florian is a former founder. He has also been engaged in the ecosystem on a more political level. So that is super interesting. And now he's in a position where he leads across Europe. So I'm looking forward to, State of the Union from Florian, what's going on out there. So welcome on the show, Florian.
Thanks so much for having me. Good to see you again.
So there's so many different ways that the different firms similar to PwC, or at least that work as advisors to the venture ecosystem, engage with venture. Let's just lay it out for everyone that's listening. How does PwC engage with the ecosystem?
Yeah, so we do it like you're already pointing on in two ways. First, I joined the firm 5 years ago with the mission to make PwC itself a good partner for startups and technology companies when it comes to collaboration. What does it mean? We set up PwC's first venture capital fund globally, being the first big four, starting investing in startups with our own money to put our own skin in the game. We continued with investing in venture capital funds, and we are building our own ventures and joint ventures. So this is in place, and it's still one part of my responsibilities. But of course, yes, we are a global advisory firm. And it makes so much fun that we support many, many clients globally if they want to set up their corporate venturing activities. Corporate venturing is for me venture investing, of course, but it can be venture clienting and venture building as well. And this is aligned to our startup and scale-up network. We are a product advisor of many, many founders across the globe. In my home country, in Germany, at this moment, we serve 85% of Germany's unicorns. So, but that's the most successful ones, of course. We support hundreds of founders per year with knowledge about how to engage with large enterprises, how to find enterprise clients, and of course, you connect them. And that's maybe the most fun of my role today, being a former founder who experienced how difficult it is to find the first clients and to do sales for a startup. That's really great to see how we can leverage PwC Salesforce database and our network to make it easier for today's founders.
Maybe here, Florian, could you share a little bit on, what has surprised you the most from, being a founder to now being on the other side of the table?
Well, it was 5 years ago. It was a kind of walk the talk moment because you mentioned that I did some politics. So I've been founder and chairman of the German Startups Association, and I've been co-founder of the European Startup Network. And I was not really happy about the way European corporates engage with startups. In Germany today, 96% of R&D spendings are spent internally. And I strongly believe that you can't reinvent traditional business models while not working with external innovators like startups. And after complaining so many times about the role of the European economy with regards to innovation, it was this walk to the talk moment to be asked to do this for a corporate for the first time in my life. What's the difference, right, Jeppe? I think having your own startup is a management of a lack of resources all the time. You are personally reliable for a lot of stuff, including the office rent and stuff like that. So I don't miss those things, to be honest. It's quite convenient that I get a new laptop within an hour if mine is broken. And to be able to work with really smart people. And we have more than 380,000 across the globe. And they are all very smart. That's a great privilege and something which is like a superpower of a company like PricewaterhouseCoopers.
When you then look across the corporates you have been able to help, are there success stories you can share with us? Who out there is really good at nailing this, right? Because it's not an easy task for corporates to engage with startups.
Yeah, of course, we could talk hours because now we could discuss, are we talking about venture investing or is it venture clienting, right? Maybe the most general topic is the mindset, right? And the question is their leadership commitment on doing that, on opening the firm for external innovation. If the mindset is in place, and you need this mindset in the C-suite, you need a CEO, in best case, or another C-suite member who is driving this, who is pushing boundaries, and who is committing the firm to do this. I think that's the most important step. And then again, we can talk a lot about way of working, way of doing this. I think it starts with a good strategy. It starts with a good foundation. It starts with knowing where to go. So, for example, where to invest or what are the main topics you want to drive. And if the strategy is in place, maybe you hire a former founder or somebody who was in venture capital, and then this could maybe a good starting point to do this.
I think it's true, right? The combination of having somebody internally that leads the effort, and I fully agree with you that leadership support is key to a successful corporate venturing setup. So no doubt about that.
Despite all this, and that it is quite self-evident that of course you want that, we still have this situation of the average lifetime of a CVC being 3.7 years. Where are you seeing the mistakes being made?
Yeah, that's the valley of death for all CVCs. Why is it the reason? I think you can put it in relation to the average term C-suites are serving on boards. On public listed companies, it's even a shorter period. They stay on board sometimes. And after 3 or 4 years, you can't show up with successes, right? There is no success story in your portfolio. Most CVCs we see invest early stage in Europe. Maybe in the US it's a bit different, right? But in Europe we see most early stage, in most times early stage venture capital investors in this corporate space. So it takes 5 years, 7 years, 10 years to see the first exit in your portfolio. While you already have faced some write-offs, of course, within the first 3, 4, 5 years. And when then there's a management change and a lack of commitment, maybe, when the external environment is changing as every day at the moment based on geopolitics, and I don't want to put the full list of disruptional stuff on the table right now, but everybody's aware of this, then it's tough times for venture units. Of course, you can try to think about this already when you set it up. We try to do this with our clients to make our clients' venture units more resilient. But that's from my experience, is the main reason.
What are the key things that you do, the key steps that you take?
Perfect world, a management team decides to put a strong capital commitment in place, which is not depending on a yearly budget or even on single deal decisions, deal by deal.
Yeah.
In this perfect world, a common understanding that corporate venture capital, and venture capital in general, by the way, is only working with a strong portfolio approach. If you don't have 20 or something buckets in your startups in your buckets, then it can't work on a long term. And that's the perfect situation.
How do you broach this topic in the best way with your clients? Because it's always, I was at the EBAN Congress the other day, which is of course a group of angels, and I came with a provocative statement that there is a lot around portfolio modeling that you guys need to understand, and you need to understand that this is the truth. Sometimes, like I also had in that presentation a disclaimer saying don't shoot the messenger, because it's of course not how most angels invest. How do you best talk to corporates that have been hugely successful in everything they do, and that's what have brought them to the position where they can now start thinking about doing corporate venturing? How do you make them understand these very different rules of venture?
We are talking a lot about best practices, of course. Of course, in any industry on any continent, you will find good examples for companies doing venture investing for many years. And some are doing this in a successful way of doing it, and others failed in the past, of course. And if looking at the best practices and worst practices, it's very helpful. We are operating global venture capital roundtable with 150 professionals at the moment who are meeting on a regular basis, and those people I love to invite to clients who think about setting up those funds and units, because I have my experience. I can aggregate my experience with many situations I worked with, but that's one way. And of course, no CEO or no C-suite wants to fail, right? And if you look at the numbers, if you look at success stories, you see common patterns why ventures had been successful or why not. And typically this leads into better strategy and better structure for the future unit.
There's one professor that says a successful venture unit is one that has survived 3 CEOs. Then you have the right strategy that fits with the culture of the corporations. And I think there's some truth in that. And Florian, to one of the things that you mentioned before, I think the holy grail in corporate venturing is corporate startup collaboration. What I see a lot in the Nordics when I go around, I see a lot of the CVCs doing balance sheet investments. And I think that's mainly due to the size of the corporations in the Nordic region. I do, however, also when we talk to CVCs that are single LP entities, they seem to behave a lot more like straight VCs, where I sometimes get the feeling of how much have they turned VC compared to CVC, and how much can you actually benefit from the corporate if you are a single LP? Do you have comments to that? What do you see on the collaboration between corporates and startups in the 2 different scenarios?
Yeah, but holy grail is a nice term for it. Maybe I use it sometimes as well, because it's really hard for those CVC units to check all boxes, right? To match the expectation, because again, most venture funds we see in the corporate space are investing early stage, saying that these startups are too young to collaborate with. They need maybe 3 or 5 years of development before they are a proper partner for a large enterprise to work with. And for this reason, it's quite tough to match those expectations. And of course, you have a different set of KPIs. If it's a single LP corporate venture fund, even if the management team is talking about strategic returns, they will once a quarter or every year they will look on the numbers first, on the return on invest. And for this reason, I like setups in which you have a kind of separation.
Yeah.
I like a combination, for example, of venture investing and venture clienting teams. There's one team with the financial focus and one with the strategic focus, which is taking care of the value creation and collaboration.
Yeah.
And I like setups. We've seen that in the market with two sets of KPIs, and some people are mainly driven financially, like a real VC, and others are just looking at the value creation and more working on the qualitative side of startup collaboration.
I really like that you split the teams also because it is different work. And then I think for the corporates out there that are starting to go into corporate venturing and direct investment, study portfolio theory, right? Because there's something when you start with your first couple of investments to go later stage, to get an exit sooner rather than later. And that goes as well for VCs as it goes for CVCs. Right?
I was actually about to ask about that. Why do you think that corporates, maybe particularly in Europe, but corporates in general, end up picking an early stage strategy instead of a Series A onward strategy? When you have this situation where you just know that the strategic value is very hard to get out of a seed stage firm.
Yeah, that's always when reality hits, right? What's the amount of money available to invest? Of course, when the C-suite is asking me where to go, I would say go for growth and late stage investments. Your term is 4 years or something like that. You want to show up with results. Pick some growth or again late stage investments. So maybe you can even go public with this investment during your term on the board, right? But see how many European corporates are committed and or able to invest more than 100 million per year or something like that to be able to do this. We see those corporates, a lot of them in Silicon Valley and the US, and they are quite successful, I think, with this strategy. But that's the main reason. Of course, when it comes to strategic returns, you can say if you want to set up a CVC for this water function to see what's going on in the market, to have this early indication about new trends, then you'd have to go early stage. But I think you could cover this with LP investments and venture capital funds as well, and track the deal flow instead of building your own one.
I think one of the things that I've seen, right, why corporates don't go later stage in Europe is that they're super afraid of the valuations, right? The enterprise value multiples that you see in startups compared to their normal business, it is so different, right? So they don't really understand why they have to pay that much.
Yeah, of course, fair point. And even it's even worse or even stronger where you see it when it comes to family businesses, right? So they invest their own money out of their family's pockets. And then for them, sometimes I do get the point, right? It's sometimes hard to believe why a 3-year-old startup should be
worth more.
more valuable than a business unit they're operating for 50 years or something like that.
And then even when you see kind of the hot sectors, right? So right now, those sustainabilities, they are priced fairly high. And then we have dual purpose, right? Defensive tech that is just skyrocketing and the valuations are insane. So for the corporates looking at that, it's like, well, they don't even have revenue. And then they go around with those multiples. So it's that's a scary part.
Florian and Jeppe, I'd love to ask both of you, how do you help us? So we've just nailed down, probably would be smart to do growth stage or at least Series A onwards. Money is very big there for corporate. There's many good reasons for that to be difficult for many. So how do you then help a corporate think through, should I do early? Should I do seed and pre-seed as a corporate VC and set that up? Or should I do some type of corporate clienting, corporate venturing, other engagement models? Or should I do an LP model instead? How do you kind of juxtapose these and the values that you're able to get and what you need to think about when you set it up?
Yeah, so with regard to your more general question, we have a small framework in place which is quite well explaining differences and different goals between the different venturing approaches like venture building, venture clienting, venture investing. And of course, you can add M&A to such a discussion as well, because sometimes it's, or sometimes often I'm the first discussion is with the M&A team, having the task from the board to make an evaluation on venture investing. So that's the first thing. Is of course, it's like questions about what's the time to market, what's the amount to invest. Venture clienting is producing fast results with low invest, of course, while venture capital investments, of course, based on the stage, have a higher amount of invest and mid to long-term perspective. So that's the general perspective or general way of doing this. And when it comes to setting up a corporate venturing unit, we have our own framework with 10 building blocks. And of course, it starts with the corporate strategy. What's the purpose? Is it for financial purpose? Is it for strategic purpose? Is it for, and most times it's a moment for strategic purpose. Then you look at the capabilities, you look at the investment areas, where to invest is maybe indicating if you can go early stage or if you have to go more growth in late stage. But many times the available amount to invest is driving some of those decisions, of course. And other parts of this 10 building blocks framework are, of course, structure, governance, who's making decisions, who's on the investment committee, how does the reporting look like, what kind of people do we need, and everything you need to operate a venture unit or venture fund.
I think, just like, adhering to what Florian said, right? It comes from the strategy and it comes from the foundation that you set up for your corporate venturing entity. And there is something about, speed to relevant KPIs. And when you do the corporate clienting piece, you are more likely to get something out of it that you can use internally. I think a lot of the early stage approaches from the European corporates also comes from what we see in venture capital in Europe. It tends to be smaller funds doing, spray and pray models. There are a couple where they do, 12 investments in a 100 million euro fund. And maybe that is something for the corporate to look at, treat it more like private equity. But that also means that you need to solve the complexity around corporate startup collaboration. Because if you go in there and figure out how to work with that holy grail, and you understand how you can unlock all the value triggers from a corporate and put that into a startup that is at Series A, and actually help them without going the other way around, because it tends to be, a group of FTEs from the startups that tries to solve a problem for the corporate. But if we could find a level playing field where it was both parties that on an equal basis, try to solve those problems, I think you could take it quite far, going, a little bit later stage with fewer investments in your CVC.
Yeah, maybe nothing to add here, so I think I could say only the same thing with other words maybe, but I agree on that. Yeah.
Florian, I'd love to ask you a bit about, because you had the background in politics, policy, representing the startups, then you jumped to the other side, hoping to probably also make a change there. I'd love to ask you, what's your observation when you look at the path forward to getting more corporates and startups collaborating? Is there something to be done on a policy level, or is it purely driven by the private markets here and a sophistication or just further development of how we think about this in Europe?
Well, I think you can't fix everything with politics, right? Yes, there are some things happening. I think politics can be supporting in funding ecosystems. like especially in the early stage, that's question who is starting those associations and how to fund them and who's committed to do that. I think European politics is doing good stuff when it comes to backing the venture capital ecosystem with the European Investment Fund and national development banks in some countries who are doing the same thing, being investor in venture capital funds, or anchor investor most times, and we do have some direct investing units as well around, which are quite successful in what they are doing. We have a new government in Germany since 4 weeks or something, right? 3 weeks, not sure. They have a nice plan. They want to introduce tax depreciations on digital investments. So for me, it's a key question how to enable the traditional companies to buy more from startups, to buy more technology, to invest more into AI adoption and all kinds of cloud and digital solutions, and to provide the chance to write those investments off faster. It's something I like, and I opted for in the past already. But at the end, I think it remains the mindset question for the corporate leaders. When I see that in the US, close to 50% of venture capital investments are backed by corporates, and in Europe it's, how much is it, 25% or something like that, then there's a lot of way to go. And of course, US corporates don't invest into startups for charity reasons. That's business, and that's how they reinvent their traditional business models and stay ahead the wave, the curve. And I hope that more and more European corporates and of course family businesses understand how important this is.
Many would say that part of the reason here is that the corporates in the US are just much larger, and for that reason there's more activity, and they will also then be able to go late stage instead of early stage, which also affects how much money is deployed. Is there truth to that, or do you think it's much more a mindset thing?
Of course, there are some advantages here, right? If you see those high margin technology companies like Apple and Microsoft, they have, of course, much more liquidity compared to some traditional business models in industrial or other spaces. We do have more or less all of them are public listed. They can acquire companies with their shares to make share deals. It's something which, for example, family business can't do. Partnerships like PricewaterhouseCoopers, by the way, can't do as well. And of course, there are some reasons. But once a year, I'm joining the Global Corporate Venture Summit in Monterey, California, and I always use this visit for meeting many corporate VCs in the Bay Area. And for example, I've met this year AMD Ventures, and I think I must check GPT, but I think they are at 22 billion in revenues at the moment. And I think they invest more in venture capital than any European corporate is doing right now. So I don't want to disclose the number because maybe it's confidential, but it's impressive. And you would find many companies in Europe being above 20 billion in revenue on an annual basis, but you will not find many investing, maybe not any investing the same amount of venture capital.
So it is, in other words, very much a mindset thing. What can we do on a narrative level, as an ecosystem, as actors that are trying to talk to corporates? Where should we focus our efforts when it comes to changing this mindset? Because we have a ton being done by policymakers towards getting founders more active or getting more people choose the path of entrepreneurship. We don't have a similar approach to trying to get corporate leadership engaged more with the startup ecosystem.
PwC is publishing a global CEO survey, so we are asking CEOs of the largest companies across the globe on their opinion, and publish it once a year at Davos World Economic Forum. And roughly 40%, I think, this year's report says 42% of CEOs don't think that their business model is reliable for the next 10 years if they don't change. Or we can ask why it's only 42%. What do the other think? But there are answers on that, which maybe we don't have time for this one or this another discussion. But I like to ask the question, for example, name me an example of a large company which was able to reinvent its business model out of itself without working with M&A or venture or startups. And reinvention in today's terms is close to disruption sometimes. Yeah? Is the traditional company able to disrupt itself? I have a strong opinion on that, and even I don't know many examples. Yes, we can talk about Amazon with the Kindle and ebooks, but I think that's the luxury situation if you are Amazon and introducing digital books while maybe disrupting your printed ones. But please, I could answer you. I could ask you the same question right now. I think I don't meet many CEOs having an answer to that one.
Yeah.
And that should be the starting point, because there's so much that's changed. There's so much ways of getting disrupted by regulation, by geopolitics, by change of customer behavior, by climate, by full stop, right? We could continue this. And I think you can put many numbers on the table, but even those examples, which invent questions, which creates the need of thinking about how to innovate a traditional business, but how to reinvent it.
I fully agree with you, Florian. It's super difficult to reinvent yourself, and it's seldomly seen, right? What we see a lot in the US is that they have done a lot of innovation. So when you look at the big companies in the US now, a lot of them are former startups, right? So they come from that and have been, and they're not that old as they are here in Europe, right? So the European companies are super old. One of the things that I can't stop thinking about, right, is that also the way we remunerate C-level in Europe is not to take that big risks, right? The amount of stock options that they get, and even if they are part of a family-owned business, right, that's not where it is, right? It's normally bonuses that are tied to what's going to happen the next 12, 18 months, right? But do you have you looked into that in your survey or anything, Florian?
Not in that one, because it's general businesses and not venturing the survey. But I think we are talking the whole time about collaboration with startups, right? But when it comes to this mindset thing, even if you don't collaborate with startups, which would be stupid, by the way, but if you would do it, you have to adopt the way of working, right? And it's about working agile, of course. But then it comes to the risk-taking culture. It comes to incentivation. I would look at the incentivation of venture capital general partners, for example. How do they take decisions on investments? What's their skin in the game? And what can you adopt from those structures on corporate structures? And there's something you can do if you want to go this way, of course.
I'd love to ask you, Florian. This is a question that both goes to corporates, but also goes to the ecosystem and those of us acting in the ecosystem. You just had Super Venture happen and Super Return happen in Berlin this week. And now that I sit here and think, there's not a lot, if any, corporates part of Super Venture. Super Venture is a GPLP thing, and it's honestly the only group that's there. There's another group that we here at this as the CVC podcast are trying to champion, that this partnership is incredibly important, both for your value and all this, but there's also a lot of money to unlock potentially if you figure out how to work correctly with the corporate. So my question here goes, of course, on the LP angle. On the one hand side, when does it make sense for a corporate to do these investments? How much? So on and so forth. Is it a good way to start exploring doing a venture fund or doing a CVC? That's the one question. And the other is, do you think that there's an increasing, because that's obviously Jeppe's and my view, there's an increasing role to be played for the ecosystem in bringing together the corporates and the VCs in the same rooms talking about the same things, so that they get more familiarity with each other. And not only the CVCs, honestly, because the CVCs are already committed and doing it, but also the corporate executives.
If I have the numbers right, 2/3 of corporate investors investing in venture capital are limited partners as well. So I think that's a quite good number, and underlines that there's a huge need for LP investments, or a huge need or advantage in it. Maybe that's a better explanation. What's a good reason to do that? I think, yes, it can be a good starting point. Setting up a venture unit often takes a year. Finding the right structure, strategy, team. That's a year you can already start learning while working with GPs of venture capital funds, while being the limited partner. For this reason, this could be a good step. Building up a CVC unit with your deal flow and everything maybe takes more than a year, right? And how you can way to accelerate your access to deal flow is being limited partner. Then quite often we see the strategy, of course, when it comes to scanning other regions. For many European family businesses and smaller corporates, it's not possible to have venture teams in the US, for example, or in Asia, or everywhere around. And maybe you shouldn't have this if you only spend 100 million or something like that over some years in venture. But investing in venture funds across the globe can make sense. And if you go to the US, of course, you find some venture funds in each vertical, so you can get very good pre-qualified deal flow. And of course, last but not least, talking about family business many times today already, I think from a perspective with the goal of financial return, it's maybe the best way of doing venture capital, even if you are investing small amounts, because it's so hard. It starts with that it's so hard to find venture professionals. Who's going to work for a CVC, right? Most talents are striving for jobs at the large names in financial investing, and but you need venture experience. Otherwise, you will write off your first fund generation or something like that, or having a high risk to do that. You need this experience. It's hard to hire them, especially if you're an SME or family business somewhere in the nowhere. What we see often, it's really tough. And for this reason, and many others, when it comes to financial play only, it's often my first advice to family business owners. Yes, they like to be business angel, and it sounds fancy, but from my experience, is one of the fastest ways to burn money is to become a first-time business angel.
That is very true. Yeah, but do you have any final questions before we close?
Not final questions, but just rounding it up from my side, Florian, immense knowledge with you. I can only recommend highly that people have a look at the PwC and Florian's team before starting this up. There's so much truth in what he's saying. So, go and have a chat with Florian if you want to know more. And we also look forward to having you on stage for our first EUCVC summit at Tech Barbecue in August. So looking forward to that.
Again, thanks a lot for your invitation today and for the Tech Barbecue. I'm looking very much forward to it. And yes, I'm quite frequently around at conferences, starting next week again with Viva Tech, later the year with Slush. But most important one is August, of course. So yes, looking forward to any kind of message to meet your listeners.
Florian, thank you so much.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.